Hi, my name is Jeffrey Cohen, investment advisor representative with Chicago Quantum. Company name is U.S. Advanced Computing Infrastructures Incorporated. We're a registered Illinois investment advisor. We work on a non-discretionary basis. We build portfolios. We run quantitative analysis. We also, on our own account, trade. And generally speaking, we do better when we give advice to other people than when we trade our own money. And so we are, that's why we only trade roughly 4% of our net worth. Even if we lost it all, it's fine. That's not how we're doing it. So wanted to talk to you about an idea that I had this morning, which is, why don't I set up a fund? Why don't I model out a Chicago Quantum Net Score uprun fund? Now, this is a paper trading fund because we have not yet signed all the papers with our custodial in order to have a fund where we can manage multiple accounts, or even our account, in a very formal and a very well protected and structured way with a true, money custodian. But it's fine. It's a start. And actually there's a couple of questions. And what I'm going to do is I'm going to walk you through the answer. And then I'm going to walk you through how we come up with the answer. And then I'm going to walk you through some of the questions. And I think it's pretty cool. So this would be today's portfolio. Hopefully we're right. I'm also hoping that maybe some of y'all will come to our rescue before we actually start trading real money and work this out. But let's start it off. So what we're looking at here currency. And we built a least common denominator portfolio. Of course, you can scale it up, but right now, all you really need to do is have $4,400 long and $4,400 short in order to run this investment. And so the first thing is, here's the stocks. So Coin, Melly, NVIDIA, Silvergate, SI Time, Digital Turbine, Dillard's Department Stores. Here's the price that they opened. So we ran this last night based on closing prices. So the assumption is you would buy it at the open. Now, you might buy it 5 minutes after the open. You might wait for it to drop a penny or go up a penny. You might do whatever you want. But this assumes that August 30th close data, you buy at the open. Here's a number of shares. It's interesting because they're real odd lot sizes, but that's okay. Your initial investments are all right around $875. And there's a 7-stock portfolio, and there's a 5-stock portfolio. And I'll explain what that means. Then this column has beta. Beta is the correlation between each stock over the past year and the S&P 500 index ETF that tracks it. So any tracking error, it just is what it is. It's going to be in the beta calculation. And you can see the betas range from 1.9 to 3.2. Those are pretty high betas. A 1.0 tracks kind of point for point with changes in the S&P 500. Now, you've got the longs, right? 7 stocks for 61.7630 or 5 stocks for 44.0860. So now you're going to have a short hedge. And the reason is that our model is expected to outperform the S&P 500, but you do need to hedge against a bad day like we're having today. So today the S&P 500 is down, and so you want to hedge away that risk. So one way to do it is to just short the S&P 500 ETF 15 shares, which is about $6,000 at the open, or 11 shares, which is about $4,400 at the open, you have a net starting point long position of $177 or $937, and your investment goes up as that net long position goes up. Now, what you could do is you could continue to basically keep invested and then continue to increase your short hedge. And the hope is at the end, when you close out your S&P 500, you've made money. Okay, so a couple things. One is, and I'm going to make a note. I'm going to make a few notes for you. One is that there's an equal weighting or amount invested per stock. And rebalancing is required, maybe not every day, but let's just start by assuming every day. And look for new stocks to add and stocks to remove each night for adjustments at the open. So we run the model every day. We have a beta every day. You would look to rebalance. And so if Coinbase doesn't show up tomorrow or tonight's run, then you got to pull it out. And you got to replace it with whatever the next stock is, right? And so there will be trading costs. And so in a perfect world, and we're going to assume now because it's a paper portfolio for $4,400, so you can afford the trading costs, we're going to assume that, so the note is, there are high trading costs if we rebalance every day. To reduce them, maybe rebalance once a week? Question mark. There are tax implications because you will be selling winners. So maybe you got to deal with that now. You got tax issues, right? And so, again, perfect world, rebalance every day. But who knows? Let's see. So Jeff, how did you come up with this? This is really weird. I don't understand. How did you come up with this? So the first thing I want to show you is we produce a spreadsheet with all the stocks in our uprun. And so what that means is these are stocks that are profitable, that operate their headquarters in the United States, so they're U.S. domiciled, they're listed U.S., they're profitable, and they pass a whole bunch of data validation, including that they traded a minimum number of shares every day for a year. So there's no IPOs from like 3 weeks ago. So there's a stock we like, Qubits, which is D-Wave Systems. We actually own a little bit of D-Wave Systems warrants. Yeah, that's not in here because it's only been trading a few weeks. And so let's take a look. So the best stocks were NVIDIA. I'm going to blow it up so you can see it. NVIDIA is awesome. In comparison to the S&P 500, NVIDIA is actually better. Then you have a semiconductor company. You have money manager. Look at that. Apple, number 5. By the way, we didn't make this up. Apple's the 5th best stock in our model. Microsoft, Carlyle Group, Ameriprise, BlackRock. So you see money managers, big tech, and chips. Synaptics, chips. And then you get some really low-risk guys that pop in because their riskiness is so low that it justifies maybe having less return. P&M Resources, Berkshire Hathaway, Crestwood Equity Partners, Marsh & McLennan, Cintas, McDonald's. But then you come back to some more risky ones, like Alphabet's in there, T. Rowe Price, Analog Devices, Broadcom, Intuit, KLA. So you're seeing now a mix as you get down to like 30s and 40s, different types of stocks, right? Pepsi with McDonald's, CDW that sells machines, Honeywell, Yum Brands, Power, another money manager, ADP and business to business, Texas Instruments. So you would look at this list and you might be tempted to say, oh, I'll take a little, this is what we do in our personal accounts. Oh, I'll take a little bit of that. I'll take a little bit of this. I'm feeling good. I feel emotionally solid about McDonald's because I had a hamburger yesterday. So I'm going to go buy some McDonald's, right? That's not how the model works. Model's totally different. But this is cool. Like if you can only buy one stock, maybe you bought NVIDIA. Now, NVIDIA may crash for the next 3 months, right? But it has a great risk-return profile such that an equalized measure of risk is smaller than an equalized measure of return, and that NVIDIA is expected to return 14% inclusive of dividends. Volume is a healthy 108%. Last day close, you're down 31.5%. You're getting this thing at just a screaming discount, NVIDIA. High variance, though. You're not going to sleep well with NVIDIA. And it pays a tiny dividend. Who doesn't love that? By the way, just to show you the other data, right? I'm going to show you some of the other data that we produce. It's pretty cool. So the market cap of NVIDIA is $392 billion. Cash flow from operation is 9. So 400 to 10, that's a 40 to 1 cash flow. That's expensive. Long-term debt is only 11 billion. It's not much, right? It's probably rounding error. Net income 10 billion. So net income and cash are about the same. That's a good sign, right? Common equity is 26 billion. So you're trading at like 14 times equity or 13 times equity. AOCI is nominal. It's basically the same as zero. And intangible assets at 2.2 billion is next to nothing. And so here's a stock that's trading on love. 40 times multiple to cash, 40 times multiple on earnings. It's got just a tiny bit of debt. It doesn't have a lot of AOCI or intangible assets. It doesn't even have much equity. You're basically living on love with NVIDIA. There's nothing wrong with that. I live on love. I'm married. I got it. I get it. But that's not a way to build a portfolio. So, Jeffrey, how do you come up with the 5 or 7 stocks? Quit teasing us. All right, fine. And quit with the spreadsheet. I get the spreadsheet. Spreadsheet's pretty simple. By the way, what the hell's the beta? Why do you have beta in there, right? Let me zoom on in for you. We're going to have a quick point on the open question. So these stocks, if you buy the 7 stock portfolio, these have an average beta of 2.6. So these move on average 2.6 times the S&P 500. So in theory, you could hedge away all of the market risk of these stocks and just capture the alpha. And the way you would do that is you wouldn't hedge 6,000. You would hedge, what would be the beta neutral hedge? So if I wanted to get rid of all of my beta, my beta neutral hedge would have to be 6176 times, I'm doing it in the wrong place, excuse me. It would have to be the total market value of the investments times beta times -1, because we're hedging, divided by, of course the phone's ringing, divided by the price of the S&P 500 ETF. So if you do that, now you're hedging 40 shares, 40.2. And you can do the same kind of math here, which is an even higher beta. I'm sorry, the phone is ringing again. So this is a $4,400 portfolio times beta times -1 because we're hedging, divided by the opening price of the S&P 500 ETF, and that's 30 shares. So that's a much different hedge. We're actually going to check it both ways. And my gut tells me that the right thing to do is to hedge at beta neutral, but that is so sophisticated that I don't know that I want to do that. So, but we'll talk about it. It's interesting, right? It's interesting. So that was an open question for us. All right, fine. Let's make those are numbers. So that should be a number. And you got to do round shares. So it's a number. Got it. So it's 40 shares. All right. Good enough. It's not quite right, so to speak. But if I just make, I'm not going to hard code it. So I'm going to leave it like that. So 5 shares and 7 shares. Jeffrey, how do you come up with it? Talk to me. So now we're going, and I'm going to share with you in the model. Now nobody's watching, and my guess is some people may watch after the fact. You know, we publish papers and stuff, and some people care. Not a lot of people really want to get into it, but it's so for us. This is what we do every day. This is so fascinating. It's crazy. Yeah, I'm looking off monitor to see how much money I'm losing on my long investments today, and it is dramatic. It's the kind of thing that would give me a stomach ache if I didn't have a steel stomach. So this is a model that we ran at 7:45 p.m. And by the way, this model is powered by Intrinio. Intrinio provides the data. Thank you, Intrinio. So, 7:45 last night, and we have a floor on our S&P 500 return because that's what we expect people to want to make. Minimum expectation of new money invested is 7.5%. And so your market return to risk is 5%. So a couple things. The minimum volume of a stock is 1,000. It has to trade above a quarter every day, close above a quarter, and under $10,000 a share. You know, 11,000 tickers traded yesterday. 2,566 made it through our first validation. We have no foreign stocks in our model, which is just terrific. Minimum and maximum beta values, Silvergate Capital, Blue Rock Residential Growth REIT. Expected return if you held all 2,144 profitable stocks is about 7.34%. And this model has a very high degree of precision, minus 8.1 times 10 to the negative ninth. So it's a pretty accurate, pretty tight model. Now, as you saw on the spreadsheet, the best score is NVIDIA. So you keep going through, and there's lots of data here. Like, what are the stocks with the most volume versus last year? Who knew 3M is trading almost 900% of last year's volume? What's going on with 3M? Are they being acquired? Right? And these are stocks with very little volume. Data Storage Corp, Air Industries Group. Let's see if there's a company I've heard of that has very, very low volume. Urban One Inc. It's not really trading. ATI Physical Therapy. 16% volume. It is left for dead. It's interesting. All right. we run a genetic algorithm. We call it our FAST genetic algorithm. It's just a technical term. And that gave us these 5 stocks. Those actually are the best 5 stocks. It takes us about 20 and a half minutes to run that one. This one takes about 19 minutes to run. This genetic algorithm we call exhaustive. And that also found the best portfolio in about 19 minutes. So in theory, we could stop from here. We could just have 2 genetic algorithms run. Whole thing's done. But the difference is we like to experiment with different solvers and all that. And so yeah, we dig in a little. We run a D-Wave simulated annealer. This is not a quantum computer. This is a simulated quantum computer. And that got us NVIDIA and the spider. That's interesting. Not a great answer, but it's an interesting answer. Then if you run our own bespoke simulated annealer, this is our own simulated annealer. This gets you a ton of stocks, right? Then we got a couple of Monte Carlos, which is interesting because they're seeded with the best stocks from the CQNS score. That's why you have NVIDIA in all of them. And not bad. One of them has Carlyle Group in there. One of them has B. Riley. One of them looks like Manhattan Associates. And one of them has Etsy. It's just so interesting. They're all going to run different Monte Carlo, different random shots, right? And then we take all of our best answers. We have 850 portfolios that at one point in the analysis were better than the previous runs, right? Better. So if you do Monte Carlo and you do 14,000 shots per portfolio size, you got a couple of bests. The first one it finds is the best. And then maybe the 10th, and then maybe the 100th, and then maybe the 1,000th, and then maybe the 14,000th, randomly, are the best. And so there's 850 bests. We remove duplicates. There was 1 duplicate. It's not bad. It means it's a pretty good random set of samplers. These are not biased towards like a couple of favorites, right? 1 duplicate out of 850. Wow, I'm selling myself this model. I should be a customer. This is awesome. Calm down, Jeffrey. So, best score so far, and then we run the genetic algorithm exhaustive, and we run it for about 10 minutes and 8 seconds, and you got the same 5 stocks. So, and then there's positive skew stocks. Some people like to invest in positive or negative skew stocks. Some people just like that. Some people want to invest in leptokurtic low variance or platykurtic high variance because you get a different experience. We actually have investments in Verizon because it is leptokurtic and low variance. So it can leap, but it's very tight normally. So it doesn't move a lot. Now what's happening is Verizon has been moving a lot negative and has been killing us. So it just really hurts. But there's a chance it could pop the other way. Because it is leptokurtic, most of its values are in a very, very tight range. But every once in a while it pops. I think it popped 3-4%. We're back in the money, baby. We would actually be in a profitable position with one nice leptokurtic pop. It's just a different way to invest. Okay? So now you go through it. We have a standard risk rating. We have a 100% dividend bias mitigation. So now let's take a look. So this is your CQNS score. The more negative, the better. And so it is 5.2 times 10 to the negative 4. Your variance of these runs is 1.8 times 10 to the negative 4. So you can see that the return, when set equally, is outweighing the variance. Roughly 3 times. That's great. Hey, Jeff, thanks, man. You give me 3 times return for the... In fact, it's more because it's a... To be precise, it's 4 times the return. The return is 4 times the variance on an equalized, normalized basis. So that's kind of cool, right? So my expected return, and I'm doing the math, it's close. It's close. It's about 4 times the variance on a normalized, equalized basis. Jeff, you're not answering the question. How do you get to the 5 stocks? All right. So the best answer is 5 stocks. Those 5 stocks, Coin, Melly, NVIDIA, SI, SITM, are the 5 stocks in the 5 stock portfolio. But I know that sometimes we want to hedge our bet a little bit. And so by giving up a couple of ticks, I can go to 7 stocks. I'm giving up 33 ticks, or 3 times 10 to the negative 6 in value. It's not a lot. Okay. And I get 2 more stocks. Now I could go crazy, and I could give up 100 ticks, and I could end up with either 12 or 13 stocks. And I might do it based on what I like, right? I might look at these and say, well, I like AMD. I want that one. Or a good example, I might give up a little more value and pick up BX, Blackstone. Or I might give up a little less love to pick up Blackstone. Here, now I'm at 57, 457 to 522. I'm giving up 55 ticks, but I'm picking up Blackstone. And I'm picking up Lending Corporation, right? I want to be contrarian. I like it, right? And so we're not going too crazy here. We just went from 5 to 7. But this is where, in speaking with an investor, you can kind of walk through the different stocks. And they might just really like I really like Blackstone. I want Blackstone in my portfolio. I would love it, right? But then the answer would be go buy it for your own portfolio. Don't mix it up with the model. Know that it's a good stock. Know that it pays a dividend, but don't mess it up. So we'll just keep going through the rest of the data. There are a lot of these portfolios. And in fact, you can get a pretty darn good portfolio with like 29 stocks in it. And they get bigger and bigger, right? I mean, you can have half the edge. Where are we at? So the total number is 5.2. So if I wanted to go to 00026, I give up half the edge. But I got 50 stocks. Now 50 stocks means I'm sleeping great at night. But it also means I'm probably not getting much of an edge. 50 stocks. But that's probably the way most individual investors would want to play it. They don't want to ride the edge. The individual retail investors wouldn't want to ride the edge. They'd be like, Jeff, I'm happy with a 50 stock portfolio. Love it. Set me. And by the way, it justifies why you're charging me, let's say, 2%, right? Whereas you're running 5 stocks, yeah, you're a crazy man, and you're lazy. So that's what I'm talking about. That's how you can think about it, right? You can take the whole edge, or you can buy half the edge. And then there's other stuff that's important. We have best and worst stocks. And then we have just lots of data. And then one thing that's interesting, and so by the way, that's the end of the video. So now you know how we found the 5 or 7 stocks, how we structured it. I'm going to still talk a little bit, but I want to make sure that if you were here just to find out about the portfolio, that you got the answer. It's 7 stocks or it's 5 stocks. 5 stocks is a better answer, but you're only giving up like 33 ticks to pick up 2 more stocks. The second is we're starting off with a straight 1-to-1 hedge against the S&P 500 ETF. However, you could do a beta weighted hedge, which would then mean, in this case, it's 2.6 or it's 2.74 times the S&P 500 weighting. Equal weighted Rebalancing is required every day. You might be adding and subtracting stocks so that there's high trading costs and potentially some tax implications. So this is our August 31st CQNS up model portfolio. We're going to track how this does. I mean, basically, I'm going to start modeling it, and then I'm going to start putting my own money in it. And then, who knows? Maybe you won't ever see me again on YouTube. Making too much money, right? I don't know. I like when I have clients. I need clients. I've been serving clients my whole life. So I have a thing for clients. And we work it out. If you want to be a client, I don't even have to charge you that much, right? It's probably like $750 a run, 2-3 times a week. It's $2,000 a week. You get access to everything. All the best thinking. You can even tell me what you want. We could try to code it for you. I mean, wrap this stuff up. These are stocks that paid 5% or more in dividends last year. Actual versus average price of the stock. So that's kind of cool. Is Verizon in there? I bet you Verizon's in there somewhere. Yep, paid 5% last year. The stock was much higher last year, unlike now. So, beta. You have 4 stocks that we had to remove because they have negative beta. So our model does not run negative beta stocks because who is going to own a stock that's supposed to lose money? Bond Natural Life, Jacobs Engineering, Nexstar Media, Reunion Neurosciences. Now, here's stocks with very low beta values. So you might say, Jeff, just focus on the low beta stocks, like Newmont Corp, the gold miner. Kellogg's, they make cereal. Hormel Chili, baby. New Mexico's public utility. Nicollet Bank Shares is up in the UP. If you're an Uper, you know Nicollet Bank Shares, right? And other, Campbell Soup, whatever. These are stocks with the highest beta. The most risky, Upstart, Coinbase, Digital Turbine, Trade Desk, QuantumScape, I think they make screens, Grow Generation, AOSL, Alpha and Omega Semiconductor, the smallest semiconductor in our proprietary index. Here's stocks that rose really, really fast over the past year in one day. Here's stocks that fell really, really fast in one day last year as a multiple of E. In this case, E or 1 over E. These are stocks that traded a lot of shares in one day. Multiple of average was really high. So let's take a look. Anything in here kind of ring a bell. They're all really small, kind of, No, nothing really. But if you like little, small cap stuff, there it is. And here's stocks that have split. Some people like stocks that split, like Alphabet split, Amazon split, NASDAQ split, which is kind of cool. AT&T had a small split because it spun off. Discovery, and Tesla also split. So yeah, so this is what you got, and I want to thank you for watching. We're sharing a lot of secret sauce here. The reason that I'm doing it is I want you to understand kind of how we would build a model, what the issues are, how we pick the stocks. We run the model every day, and so you have to look at it and you have to figure it out. And the hedging issue, right? I think we found out a nice clean way to do the hedging. And so thanks for watching. If you like the video, hit the subscribe button. That way you find out when we go live. Like today we went live completely unannounced in the middle of the afternoon. Tell your friends, right? Maybe share the info. The reason I say that, I keep going back to it, is we're not paid to make the videos. We don't monetize. We don't advertise the videos. So it's all like word of mouth. And YouTube will share or recommend our videos if we have a lot of subscribers, because it means it's trusted content. And so thank you again. And if you want to learn more or become a client, please go to our website. Our website is www.chicagoquantum.com. www.chicagoquantum.com, and it'll look like this. This is how you know you got to the right place. I can't imagine anyone would fake our website, but I guess anything's possible, right? So, consulting firm and registered investment advisor, got all the details. By the way, we have our brochure available for free from the website. Full brochure and a brochure summary threefold, which is very nice. And you can also sign up for newsletters and updates. And then to take a look at what our services are, you can buy an up run, you can buy a down run, you can tell us what kind of run you want us to build for you. I can do investment planning workshops for high net worth individuals. And if you look at the up run, you see it's $750 and you get lots of good stuff. You get everything you saw, the spreadsheet, the write-up, and then usually we do our own little report if you'd like, and we can talk about what we saw that might be a little different. So, thanks again for watching. You take care now. I am Jeffrey Cohen, and this is not investment advice. Thank you.